In this video I'm gonna show you a little trick when it comes to the S&P 500. So we all know it goes up over time, over a long period of time, right? So I'm gonna show you a couple of good years, 1985 to 1986, December to December. We got a good solid gain there of over 24%. And this is what a $1,200 investment turns into. Remember, this is also with dividends reinvested. So there aren't going to be much dividends in a 12-month period, but that's what that's calculating. And we're also ignoring taxes because I'm assuming this is inside a retirement account. We do not pay dividend taxes. That's what that is. And management fees, you can buy a Fidelity index fund that has zero management fees, right? And expenses. So here we go. Here's the 30-year return. Good solid gain, just under 10%. And that's what $1,200 turns into with dividends reinvested. So we're just tracking that amount in 1956. We're not tracking the additional investments. And here we got 1995 to 1996. We look at that, 34% in 1 year. That's what $1,200 turns into. $1,200 initial investment, and again, that's what dividends reinvested. And over here is, well, we're looking at the 30-year return, 1966 to 1996. Look at that, just under 11%. Nice solid gain. So these are two good years, and I'm showing you the 1 year return just to show you this, that the end date has had a good time in the market. So I'm sure that when we look at the bad years, we're going to see drastically different results, right? Over long periods of time. Well, let's see if that's true. Okay. So here we got 1973 to 1974, December to December. This was a really bad time for the market. Look at that. Negative. You see the minus sign there. Negative 26%. Here we got December 2001 to December 2002. Look at that. We got another negative number. $1,200 turns into that. Over here, $1,200 turns into that. We're losing money. Here we got March 2008 to March 2009. $1,200 turns into that. We lost over 41%. So I'm sure when we look at the long term, we're going to notice a big difference, right? So I'm going to do this from scratch just to make sure you know I'm not just making these numbers up. You can actually watch this. So 1,200. And I'm going to go back to, see this one, I'm going to use 2000. Or I'm sorry, I'm going to go to 1974, and I'm going to go back 30 years. And we need 1944, one more. There we go. So $1,200. Oh, wait a minute. Look at that. That's 10%. That's, wait a minute. That's the same as, almost the same as this right here. Not quite. But, wow. Don't see a lot of difference there. Okay, so that's interesting. So I'm sure that's just an anomaly, right? The other one's got to be they got to be different. Well, let's pick 2002, and let's go back 30 years. So we need 1972. So let's just keep in mind that the 1 year return was negative 20 some odd percent. Let's see what the, I'm sure this one's going to be different. Wait, whoa, still over 10%, very close to what we got here when the 1 year return was 34% and the 30-year return was 10%. Well, how can that be? That's interesting. Okay, so I'm sure March of 2009, but that one was the, I mean, in our lifetime, that was the king of all crashes. I mean, that one you got to see the dip, right? It's got to be drastically different than what we've seen before, I'm sure, right? Calculate. Whoa, wait. Whoa. Again, here we have a 34% return 1 year. Right, this is 1996. So 1 year return 95 to 96, and then 66 to 96. And here's March 1979 to March 2009, and we get almost the same return. Now, how in the world does that happen? I don't know. Now, what I will say, though, is if you actually want to realize this gain, remember this includes dividends. So we can find out what this $1,200 grew to. We can follow that buy order. The problem is, if I type this in, let's say I'm buying the same fund, right? This is representing buying the same fund and adding an additional amount each month. Well, the problem is I'm not going to be able to know what dividends to sell, so I'm going to have to use a separate fund if it's within the same account, or I can use the same fund if I have different accounts, and then I just don't add anything to it. I just put a 0, right? And then every time I change the year, I shift these years over a year. I just use a different fund, and that way I can track what this turns into and the dividends end to end, if that makes sense. So, but yeah, isn't that interesting? 10% from 1979 to 2009, and if you look at and again that 1 year return was 41% negative. And then here we have a 34% positive from 1 year to the next, and we get almost the same thing. Now, these numbers do jump. I don't want to kid you. If we look at 2001 and early 2001, if we go to 1971, you'll see that this number is. I mean, look, there we have something over 12%. I've seen something as high as 14% if you hit the right number. So adding 2% a year, it does drastically change the number, but it's not always the bad. If you know what I mean, if you have a good 12 month period, it doesn't always equal a good or bad 30-year period. So just something interesting. And if you'd like to know an additional idea I had, check the description in the pinned comments below. I have a little bit more on this that I think would make investing a lot easier.